Okay, let's get started. I think we've got some more participants rolling in here, but nevertheless, let's get started with today's webinar. Again, welcome everyone. I am Ed Gorman, Director of Client Accounting here at Tally Management Group. And with me today, I have Mark Labady, Executive Vice President of RTD Financial. Today's webinar, Bank on It, Securing Your Association's Financial Future. We will touch on ways to invest and protect an association's funds, particularly in current times where we have so much uncertainty out there. Before we get into the meat and potatoes of today's presentation, though, let me quickly go through some non-dues revenue associations can find outside of their membership base that can help them build a base of funds that can allow them to invest and gain some earnings on some excess funds. First, we have advertisements. Advertisements, always a great external source of non-dues revenue your association can offer. They can offer advertising space to other companies and organizations for their association. There are plenty of platforms where you can offer the advertising space on. Your association website, obviously, first and foremost, and your social media serve as online advertising space. So advertisements, always great. Second, you have events and fundraising. Events and fundraising, another source. The association most likely can host events, or already are hosting events, I should say. But are you using them as a non-dues revenue source? There's so many multiple ways that you can do this. There's different types of events your association could host: galas, auctions, trade shows, conferences, which obviously most of us are already hosting, but these are just a few examples. But events and fundraising, another non-dues revenue source. Probably the biggest one being sponsorships. Sponsorships come in contingency with the events that you're hosting. It's a more consistent stream of non-dues revenue that your association can pursue. These include year-round seasonal access to members at conferences, advertising on newsletters, or tabling at networking events. Sponsorships are probably the biggest way that you can find outside of your membership dues to find external or non-dues revenue. Another one, and not so commonly used, is merchandise sales. Selling merchandise with the association's logo branding. It's a great non-dues revenue generator. Some of the merchandise ideas that we've seen out there include t-shirts, water bottles, notebooks, pins, stickers. Just make sure that your branding and messaging is clear on these type of logo sales. Again, it's uncommon, but we found it to be a great source out there. Another one we see out there is job boards. Creating a job board on your website. This gives you another source of non-dues revenue, but it also serves as a member benefit. And that's certainly important because we want to stay engaged with our members. The last one I'd throw out there is educational opportunities, a source of internal non-dues revenue, if you will, providing educational opportunities for your members. Maybe it's in the form of a lunch and learn webinar or workshop. Your members, remember that your members are career-driven professionals and they want to further their professional career. So this is a great option to be out there with them. They're just some of the ways that we thought we'd throw out there some non-dues revenue alternatives to help gain a base of excess funds. All right, so that's what I have there on that. So without further ado, I will turn this over to our featured speaker today, Mr. Mark Labady. Mark, I will allow you to take over from here.
Excellent. Thank you, Ed. Appreciate that. And welcome, everybody. So again, today's focus is really going to be about securing your organization's financial future. And obviously, Ed just touched on some of the sort of important ways, outside of from a reserve and investment perspective, you can do so. And obviously, we know revenue is certainly an important portion of that conversation. And so as we touch on some of the key highlights of what we want to cover and hopefully come out of today learning is, first and foremost, right now, obviously everything going on as it relates to Ukraine and Russia's invasion, has created a new headwind of sort of economic and geopolitical uncertainty that, for a lot of our volunteer leadership is acting as a potential barrier to perhaps want to address some of these bigger picture issues. So we'll touch on why we shouldn't really let that be a barrier. But in fact, actually, number two is really the bigger driver of sort of what should be the conversation that our volunteer leaders are focused on, and it really the impacts of, high and rising inflation, and really what that means to reserves, and ultimately to some of the decision making that's relevant today. And then last but not least, we wanted to leave you with some actual tangible next steps that you guys can take back to your organizations, and conversations you can have around hopefully taking some of those first steps towards improving your organization's future. So before we dive into sort of the first learning objective, I really wanted to kind of take a step back and really look at the last couple of years. It's been a really challenging time, as obviously everybody on this call certainly understands and appreciates from a member and trade organization perspective, because perhaps prior to 2 years ago, we weren't necessarily as focused on so much of those revenue diversifiers that Ed kind of touched on to hopefully help us be able to weather some of the impacts like what we've seen these last 2 years, where we were so unfortunately, for better or for worse, heavily reliant on the revenue that came from various meetings and events. And so with the travel bans and all the cancellations associated with that, not unsurprisingly, the average association really went to a position of maximum safety, right? It was sort of this idea that, look, right now we have no idea what the future looks like. So the safest thing we can do is just keep as much cash on hand as possible to make sure that we can remain solvent, certainly through this period. And so obviously, while it's understandable that that was an important decision, I think the baby got thrown out with the proverbial bathwater, so to speak, in some regards, because I think, our volunteer leaders, in the absence of perhaps having some of these, formal structure and policies in place to kind of help guide them through such a challenging time, really lost focus of, also sort of managing the other priority of ensuring the long-term sustainability of the organization as well. And so, again, as we kind of flip forward to 2022 and where things, stand today, as we already mentioned, if you don't mind moving the deck forward one, we've certainly seen budgets kind of return here as travel restrictions have been lifted, and certainly things have returned back to very close to, if not above, pre-pandemic levels in terms of budgets. And so with that, while that's been going on, at the same time, sort of the economic bill is coming due, if you will, for all of the government stimulus around the world, that was put into place in essence to kind of bridge the global economy and bridge the global citizens, if you will, through that period of high unemployment and lost revenue streams as businesses had to close in certain industries. And so with that, that bill essentially is what we're seeing now of significantly higher and sustained inflation, and things we haven't seen in 40 years, since the late 70s and early 80s. So the challenge that creates today, and we'll talk about very shortly, is basically that your budget expenses are going to keep increasing at a rate higher than what you've been used to, and that's not just for your current budget expenses, but obviously those that are continuing to return, as well as perhaps some new ones as well. So again, going back to that first learning objective for today, and sort of addressing sort of the most current and disturbing issue out there in the global environment, is obviously what's been happening over in Ukraine. And while it's half a world away for us here in the United States, I mean, the reality is, in a world of globalization, there are economic impacts that are felt by every country as it relates to some of the sanctions and implications from especially commodities perspective, of where companies are going to be able to source the various raw materials in order to make their products. And so again, from a social perspective, obviously what's going on is devastating, and we can't certainly diminish that in the least. But I think the most important takeaway as it relates to this, or quite frankly, any economic or geopolitical uncertainty, whether it's things in the Middle East that have happened in the past and will certainly continue to happen in the future, as well as 80 million other things, that both things we've seen and things we can't have seen coming, right? Things like the pandemic. I think the most important takeaway is that in these moments, we always tend to focus on that short-term event, and why that short-term event prevents us from being able to focus on a long-term strategy. And so, again, fear and uncertainty are sort of natural emotions as human beings. And for better or for worse, whether we're, trained in how to, resist some of those temptations, or whether our volunteer leaders who don't have that formalized training, it's natural for all of us to want to rationalize that safety and security, of things like keeping money at the bank or keeping things in FDIC insured, short-term CDs is the right choice, when we go through some of these quote unquote scarier times. And undoubtedly, again, there's always going to be volatility associated with, investing in stocks and bonds in the short run. But at the end of the day, it really is all about, being able to match up the time horizon for when you need money with ultimately trying to, determine, what is an appropriate amount to keep, not just in these two instruments, but then also in long-term reserves that are there to help with that long-term stability. So, again, I think the focus always has to be on matching, those impacts with the actual, timeline of the money. And so, often one of the things that we see is missing for organizations, and why their volunteer leaders struggle to perhaps, invest money, in scarier times, so to speak, for the long term, is they don't have that bridge bucket, if you will, to bridge between the bank operating account and a long-term investment portfolio. And that's really, one of the key recommendations we always make to our clients, is always having that middle bucket of short-term reserves, which are there not just to, earn some interest over leaving money at a bank, earning nothing, but then also to potentially cover, the small shortfalls that might happen from year to year, even in the given budget cycle. And so if an organization can, plan within reason to have up to 5 years of potentially, these small shortfalls that might happen in any one year, in essence, they can insulate themselves from all the short-term risks associated with, these types of economic and geopolitical uncertainties. So hopefully that gives a little sort of, clarity for everyone of just kind of remembering, that again, if we have a plan to deal with the short term, then we can allow the long term to not be impacted by these types of events. So turning to events that do impact not just the short term, but also the long term, inflation is, again, the other hot topic today, outside of the impacts of the Russia-Ukraine situation. And so, for the first time, we're really seeing, like I mentioned earlier, sustained inflation rates well above, historical averages. For the last 20 to 25 years, I believe we've enjoyed an inflation rate somewhere between 2 to 2.5%. If you look back at the 150-year tracking of inflation data in the United States, that number has actually been a little bit higher, and actually a little bit closer to 3%. So if anyone saw the government data that was just released in this past week, the most recent monthly print on an annualized basis came out at 8.5%, which is the highest read we've seen since 1981. And so while, certainly there's going to be government policy that's going to be put out in the months and years to come that's going to be aimed at trying to curb some of this inflation, I think the initial thought out of the pandemic that, we would see inflation be very short-lived is not going to be a reality. And so, in the moment, it might think, well, why is this important? Why does this matter for my organization? And, again, if we take that 5-year time horizon we kind of talked about earlier, just thinking about what that could mean in terms of the loss of purchasing power, that the same money we have sitting safely at the bank or in short-term CDs is essentially eroding, just sitting there, earning such a low amount of interest in comparison to these inflation rates. So, 8.5% is even higher than I even put on the sheet. But nonetheless, if you just took that 8% annualized inflation number, if we were to experience that over the next 5 years, in essence, your budget would essentially double in terms of dollars and in terms of costs. And that would be net of a lot of these, same dollars that are sitting at the bank effectively earning nothing. And once again, I can't reiterate enough the fact that that's just for your current budget, right? Thinking about if we want to incorporate new budget expenses over time, that those are going to inflate, even more and only add to those numbers. And so again, while the Fed does slowly continue to raise short-term interest rates, and hopefully we'll see these numbers, slowly move up over time, at the end of the day, for all intents and purposes, our major banking financial institutions are still basically offering no interest on their, bank operating accounts, which are, effectively nothing more, than a checking account for an individual, for an entity in this case. And even money market rates, again, with the Fed raising a quarter point, they're at least now up to that 0.25%, but still, barely moving the needle in comparison to 8.5% inflation. And then once again, even if we were to lock the money up for 6 months or a year, we're only getting, around 1% on those dollars. So, again, even if you're getting 1% a year over that 5-year period with some of those inflation rates that we talked about on the last slide, in essence, we're talking about 5 years from now, at a minimum, we're talking about somewhere between 20 to 40% less in reserves as a percentage of your budget, 5 years from now. So, as fiduciaries, and obviously every one of our volunteer leaders is a fiduciary of the organization, and part of that duty is to make decisions that are in the best interest of their organization, while emotionally leaving this money in cash and safe instruments might feel like the safest thing to do. One could argue it's actually perhaps one of the most damaging and destructive decisions they could make if we continue to see, the high inflationary period that we've seen over the last, call it 12 to 18 months. And so how do we start to, address this issue that I like to call, moving backwards by standing still and leaving too much money, in cash or in CDs? And so, using some of the numbers we kicked around without trying to go too deep into the weeds, for every, just to keep it simple, $1 million that maybe is sitting between the bank and short-term CDs, we would basically need to have an equal amount of dollars in a long-term investment reserve account growing at a rate at the same 20 to 40% above inflation, just to keep up with the lost purchasing power of the money that we have to keep liquid, right? And so, again, depending on how high inflation ends up averaging over these next 5 years, gives you a sense of the type of investment returns that we would actually need to provide in order to just preserve that purchasing power for the organization. So, if some of the Fed's activities can at least curb inflation to stay to, only slightly above average and be at a 4% rate, again, we would at least be able to offset that lost purchasing power with a pretty conservative investment portfolio, one that was only targeted to perhaps, grow at a rate of, let's say, 5 to 5.5%. Again, if the Fed's activities don't have as much of an impact as they hope, it may take a more moderate investment risk portfolio, earning somewhere in the neighborhood of 6, 7, or 8% at 5 to 6% inflation, to actually offset it. And while we certainly don't hope that we have runaway inflation the way we did in the late 70s and late 80s, if that were to happen, it would actually require a lot of organizations to actually think about increasing the risk in their reserves up to a pretty aggressive and high stock allocation, once again, just to kind of stay equal with the impacts that inflation is driving. So while I've presented probably a pretty scary but hopefully sobering reality of sort of what's out in front of us here as a result of inflation, I think there's a lot of great questions that we can take back to our organizations, to our volunteer leaders, as well as within especially our executive committees and boards, to really hopefully get buy-in to start to move the needle in these areas. And so, it starts with understanding first and foremost, where we are today. And again, one of the biggest issues I talked about earlier is just having a pathway to be able to allow people to make good decisions. So, do we understand the why behind how the investments are structured that way, right? And oftentimes that goes back to, what do our policies say, and do they align with what we're actually trying to achieve? Do we have more than $250,000 at our bank right now? Banks only offer FDIC insurance on the first $250,000. While we certainly hope that, the economic climate ahead doesn't result in, bank closures and things that we haven't seen since the financial crisis in 2008. Again, as a fiduciary, this is a very simple step we can all take to make sure that we're at least protecting every one of those safe dollars that we have to keep safe in something that is, insured, by the federal government here in the US. Again, like we spent talking about, have we thought about how much, in reserves we need to have growing at a rate to meet or exceed inflation? And then again, with that short-term bucket, can we quantify, for example, how much cash flow we might need to offset, losses that may come from budget shortages? And then, on a bigger picture basis, do we know how long we can, live with those, losses before it starts to jeopardize that long-term sustainability? So if you haven't thought about some of these things, and bringing these questions back only leave you with more questions, I think it's a great example of why would be a good time to take some action now to hopefully be able to shore up and improve your organization's financial future. So, what can you guys do? What can you take away from this conversation today to truly do that? Again, as I mentioned just a second ago, first and foremost, go back to your current policies, whether it's investment policies, spending policies, the bylaws of your finance committee or board, and how decision making is made about how much money to keep in these various buckets, so you know when to transfer between them. One of the biggest things I've seen is just a lack of a clear policy in that area, which now, even if you're doing all the right things, you might have way too much money built up at the bank, and there's no structure in place to just, quarterly or semi-annually look to say, hey, do we have more than we need here, right? Should we consider moving dollars over to a longer term approach to add sustainability, or vice versa, right? I think, unfortunately, the only time we focus on is when the bank operating account's getting low and we realize we need extra cash flow to make sure we can pay the bills. So, it works both ways, and I think it's important to focus on that. Again, going back to the why behind, all of this, making sure that, the leadership team can understand sort of the big picture of, what is the strategic direction, both for the organization, as well as do the reserves, and the policies in place match up with those, big picture direction and strategic goals. In addition, again, making sure that we have leadership to champion change. All too often, I've worked with many executive directors and account executives who completely can appreciate and understand some of these challenges. But at the end of the day, if we don't have a treasurer or a president or other, volunteer leader who can get on board and also be a champion for change, oftentimes these things don't go very far, and ultimately don't happen. So, again, I really think it's important to find at least that one or two volunteer leaders who at least, have some business expertise or knowledge to kind of understand why change needs to happen and needs to happen now. And then last but not least, always, don't be afraid to lean on your, external resources to help you not only get there, but probably get you there much faster. Right. Obviously, in working with an association management company, you've got a finance team, as well as a lot of other support to help in a lot of these different areas. And certainly, that should be your first line of defense to go to. The finance teams are typically focused on the budget cycle in a 12-month period. So where someone like myself or other financial advisors come in that specialize in working with nonprofits, it's then looking to do that financial modeling beyond that 1 year. It's that 5 to 10 year picture of what that sustainability looks like and helping understand the decisions you need to make there. And so again, not too dissimilar with some of the non-dues revenues things that Ed mentioned earlier. If you haven't done strategic planning, obviously, whether that's through your association management company or if you're looking to engage outside consultants there, strategic planning and knowing sort of the long-term direction is super critical. And again, last but not least, fundraising. I mean, obviously, fundraising we've seen be a tremendous benefit as a revenue stream to those organizations that have committed significant time and energy to formalize policies and programs there. So once again, whether it's through your association management company or elsewhere, it's definitely a non-dues revenue source that you certainly don't want to leave off the table. And we've certainly seen a lot of other organizations have success. So we've already left you with some questions to kind of bring back to your organization. And we do have, again, another another handful more to think about. But before we do so, we wanted to, again, in the interest of time, offer up the opportunity to answer the audience's questions and hopefully provide a few more pieces of wisdom as it relates to addressing some of these reserve challenges.
Great, thank you, Mark. And I do see at least one question that I saw in the chat, so I will read that aloud for you. Is the pandemic a reason for associations or association boards to spend on innovation such as new non-dues revenue programs and spend from reserves? Or should associations spend conservatively and build up their reserves?
That's a great question. And Ed, you can certainly answer this as well from the association perspective, but from just a purely financial perspective, I think if anything else, this question lends back to why you need to have a plan and the whole idea of modeling. And so, again, I think the concept is we all know that we have to invest and we have to reinvest back into any business in order to, ensure that we're, adding to our revenues and growing our revenues over time. But how much or how often or when we do that is a function of all the other, priorities that exist in an organization. So again, by modeling out and looking at, okay, if we wanted to take 50, 100, whatever amount of money, thousands of dollars to invest into some new program and project out, what we hope the revenues are associated with that, let's just say over the next 5 to 10 years, it helps us see in essence whether that's a good investment and whether that helps further the organization towards its strategic goals of, ensuring that they have enough in reserves to meet those long-term sustainability needs.
Yeah, I would agree, Mark. And I would also add that you had touched on it earlier. Coming out of the pandemic is a great time and opportunity for boards to plan their next strategic planning session. And that session will tell the organization or appointed organization a direction that they want to go with the funds and what they should invest in, and if they should start investing in innovations to help them come out of the pandemic, or if they want to be more conservative. But each board will be different. Each organization is different. Their current situation is different. So I would agree. All right. One more question. How do we know if our money is not where it needs to be?
Yeah, another great question, and certainly one we get very often. And when I actually start working with a new organization, that's the first question I love to ask is, help me understand why the money is managed the way it is currently. And you might be surprised to hear that, probably in 20 plus years of us working with nonprofit clients, the three answers or three variations of answers we hear the most are, I don't know. That's how it was since I got on the board, or that's what our advisor told us to do. And on the surface, you might think number three is not the worst answer in the world, but at the end of the day, if the organization is not engaged with understanding, why the money's, being managed the way it is, even if all these great decisions are made today, 3 to 5 years from now, as board members rotate and those people who are involved in those decisions are gone, if that institutional knowledge and that re-education to keep everybody up to speed every year, reminding them of why we're doing this and why it's important. Too often I see organizations just keep spinning their wheels, asking the exact same questions, in that 3 to 5 sort of year secular period. So I think first and foremost, it's the why, and then backing it up with, once again, financial modeling and analysis to basically help you understand exactly how much should be in each of these buckets, to fill out that unique why for each organization.
Great. Thank you, Mark. Well, I know we allotted for 30 minutes and we're at our time spot there, but again, I want to thank you, Mark, for coming on. And I know you gave us, it is a scary times, but there are ways to protect our funds and there are vehicles for such. So I appreciate your insight there. And again, thank you everyone for joining us today.
Thanks all. Appreciate the time.
Bye, everyone.